Hi, you're watching Investor Insights, and in this video I'd like to talk about warning signs that companies display when they're in trouble or something a lot sinister is about to happen. So if you're about to purchase a stock and you look at the balance sheet or you look at the reporting history of the company and you see these signs, I think the best thing to do is to stay away. Or if you're game enough, you might like to short it. So the four signs are, well, number one, you've got decreasing cash flows. Now, cash flow is the lifeline of a company. If you've got positive cash flow, as in you've got more money coming in than going out, then business is sound, because that's how you want things to be operating. I mean, to make a profit, you must always have more money going in than out. So as your cash flow decreases, it means that the profitability of the company is decreasing. Therefore, the PEs is getting higher and higher, because if the price stays the same and the earnings decreases, then the stock's becoming too expensive. Normally the market adjusts and the price will be getting lower and lower with the earnings anyway. But it's important to keep an eye out on the cash flow itself and the direction of the cash flow, the size of the cash flow, whether it be up or down. Secondly, you might have possible ASIC or SEC investigation into the company. If ever now this goes even beyond all the PEs and all those technical aspects of the company. If you hear some news that a company is about to be indicted or is even being investigated by the regulators, you should stay the hell away. Sometimes it could just be an inquiry, but you know what? Cops don't knock on your door for no reason. You must have done something. And it's the same for companies. ASIC or the SEC doesn't just knock on a company's door if there's nothing happening. There's got to be something. Keep that in mind. The third is an increase in debt. Now, if you have a company that's getting more and more into debt, such as the US government, you know that this game is about to come to an end. Because when interest rates rise, can the company afford to repay the debt and all the interest that comes with it? And is the acquisition of or the selling of debt a symptom that the cash flow is becoming so bad that the company has to take on all this debt to function? Now, when you look at debt, you've got to look at whether it's good debt or bad debt. And if it's debt that's used to fund day-to-day operation, that's bad debt. If good debt is debt that's productive, so debt that's used to grow the business, to purchase profitable acquisitions. But I think in general, if you look at a stock's debt levels, you can relate it to the stock's peers within the sector and see what their level of debt is. And if it's on par with its peers, it may not be such a bad thing. But stocks with high levels of debt compared to their peers, or even just high levels of debt, are normally things that you should avoid. And the fourth, and this is one very, very big warning sign that you got to keep an eye out on, is insider activity, and more importantly, insider selling. Now, the insiders or the managers, the workers of the company, sometimes have a vested interest within the company. The management could be the family that founded the company. So if these guys who are stakeholders start to sell off a lot of their shares, it could signify that, it could mean that the company's in trouble, or the stock is so overvalued that they're happy locking in the share price and they can always get back in later when it cheapens up. And normally it's more because of some bad news about the profitability of the company that's about to go down, and therefore the stock being overvalued rather than something bad being on the horizon, such as an SEC investigation. Because if those insiders are selling because of some investigation, that's insider trading, and well, sort of going against regulators' rules in reporting sales, ahead of big announcements like investigations and the like. But in general, if those 4 rules, with those 4 rules, you have to stick by the fact that if you see those 4 warning signals, those 4 warning signs, you stay away. But if you're game enough, short the stock.